Jerome Powell and the Federal Reserve just announced that they're going to likely cut interest rates in mid-September. This is huge news, everyone, because it means that federal funds rate, treasury yields, and mortgage rates are likely to go down more into the future. However, it also means that the economy is likely to tip into recession, because 11 out of the last 15 times that the Fed has cut interest rates in an economic cycle in the last 70 years, we've had a recession and a skyrocketing unemployment rate right thereafter. Now, interestingly, a lot of people want you to think that Fed rate cuts are going to be good for the economy. A lot of people think that home prices and stock prices are going to go up by more when the Fed cuts interest rates. However, the historical record is very clear that this is unlikely to happen. Because on this table, everyone, I broke out the last 15 times in the last 70 years that the Fed cut interest rates in an economic cycle going back to 1953. And what you can see is that in 11 out of the 15 times the Fed cut rates, we had a recession. 4 out of 15 times the Fed cuts rates, we didn't have a recession. So 70% of the time Fed cuts rates, expect a recession, and actually expect it pretty soon, because you can see after these blue rate cut bars, the unemployment rate has a tendency to skyrocket in the next 3 to 6 months. And so a Fed rate cut could actually be one of the best recession indicators there is. And the reason for that is because the Federal Reserve Chair, in this case Jerome Powell, looks at the economic data and the labor market data, and for him to indicate a big shift in what their policy plans are, he needs to be seeing something that's convincing him of that. Because the last 2 years, the Fed's mandate was fighting inflation. However, now they're saying the Fed's mandate is keeping full employment. With the Wall Street Journal reporting that the Fed has declared time has come for rate cuts, and I want you to take a look at these quotes from Jerome Powell, everyone, because they're very interesting. He says that we do not seek or welcome further cooling in labor market conditions. The time has come for policy to adjust. Powell went on to say that the cooling in labor market conditions is unmistakable, and that we will do everything we can to support a strong labor market as we make further progress towards price stability. And I think it's just really important that you guys understand that Powell's right. The labor market has worsened significantly over the last year. The unemployment rate's gone from 3.4 to 4.3%. And not only that, the number of unemployed Americans is up 21% year over year. So now there's 7.1 million unemployed Americans. There was 5.9 million a year ago, according to the government data. And you can see every time in US history that we've reached this level of 20% year over year unemployment growth, you can see the unemployment growth has just continued to get worse, and we experienced a worsening recession. And what's amazing to me is there's lots of people who are just ignoring this. There's so many people who write mainstream financial news articles, a lot of housing market forecasters, stock market forecasters, who are ignoring the rapid deterioration in labor market conditions that's happening. And in fact, the fact that the Fed hasn't cut rates already is kind of amazing. Because in most other economic cycles, by now, the Fed would have already cut rates probably 3 to 4 months ago. They still haven't cut rates today with the unemployment level up 20% year over year. That suggests that actually the Fed could be behind the curve on rate cuts. And it's one of the reasons why Powell came off a lot more dovish in his speech in Jackson Hole, Wyoming than people thought. And in 1 second, I'm going to tell you about what I think this is going to mean for the housing market in particular, everyone. I know a lot of you want to know what rate cuts and recession might mean for home prices in the future. I'm going to get to that in the next 3 minutes. But first, I want to play devil's advocate, and I want to ask myself the question, what if I'm wrong? Could I be wrong about the fact that we're going to head in towards a recession and that there's going to be a market crash? Because I know I've been saying this for a while, and a lot of people are now skeptical that we're actually going to have a recession. So I want to show you guys some data that I pulled comparing what the economy looks like today before the Fed rate cut to what it's looked like before Fed rate cuts in the past. But I want you to take a look at this table, folks. This is really concerning me here. The fact that the unemployment level is up 21% year over year. You can see that on average, in the last 15 Fed rate cut cycles, they started when unemployment was only up 4% year over year. Now, combine that with the fact that the debt to GDP ratio in America today is 123%. We have record government debt, compared to around 50% debt to GDP ratio in those previous examples when the Fed cut rates. On top of that, Americans are only saving 3.4% of their income right now. Almost a record low savings rate, whereas before in Fed rate cut scenarios, they were saving 9%. So what this table shows is that the current situation in blue is appreciably worse than when the Fed normally cuts rates before a recession historically. And so the people who play devil's advocate and say that, oh, it's going to be a soft landing, oh, there's nothing going on in the economy that's bad, they really don't know what they're talking about. They're not looking at the historical data because the historical data is very clear. Unemployment is skyrocketing a lot faster than it normally does. The savings rate is way lower than it normally does, and we have way more debt than we normally do. The combination of those three things suggests that yes, the Fed is behind the curve, and that when they do cut rates in mid-September, it's going to be a signal that things will get worse the next 6 months, not better, in the economy, the housing market, and stock market. And at this point, let's talk about those asset markets, because I know it's what a lot of you care about. And let's start with housing. Home prices are still in a record bubble. Heading towards the end of 2024. We've only seen prices come down in a handful of cities by a meaningful amount. And the result is that Americans are still priced out of the housing market, with the housing to GDP ratio in America, taking the aggregate value of the housing market and dividing it by GDP, being 176%. So the housing market is worth around 50 trillion. Our GDP is 28 trillion. You can see that this is way higher than the historical norms for housing being overvalued and expensive. In most other scenarios, when the Fed cut rates, we were at 117% housing to GDP ratio. Now we're 176%. And so what this is saying is that the housing market's in a bubble that we've really never seen before except for 2006, the Great Recession. And for that bubble to somehow sustain itself, we're going to need to see home buyers come back into the market. We're going to need to see an increase in buyer demand. And a lot of people are hoping that the Fed cutting rates will cause buyers to come back into the market. However, the problem with that is that so far, buyers keep dropping out of the market even as mortgage rates decline. You can see on this graph, which tracks mortgage applications to buy a house, the mortgage application index has absolutely plummeted over the last 2 or 3 years, everyone, to an index level now in late August of 131. Which is down 8% year over year. It's actually one of the lowest levels of mortgage applications to buy a house that we've seen on record. Now, mind you, folks, this continual decline in mortgage applications is happening as mortgage rates have dropped. So mortgage rates have gone from about 7.6% 3 or 4 months ago to 6.4% today. So we've already seen a big drop in mortgage rates. That drop in mortgage rates is already largely pricing in Fed rate cuts. And despite that drop in mortgage rates, there's been no increase in buyer demand. And so this is a concerning sign for the state of the housing market that incrementally lower mortgage rates is doing nothing to bring buyers back in so far. And we'll have to track this data in subsequent weeks and months on mortgage applications and home sales. However, it's been fairly consistent so far. No increase in buyer demand from lower mortgage rates. And you have to wonder, what's that going to mean in September when the Fed finally announces their rate cut? And if at that point buyers don't come back into the market, I think we could see a freak out on the seller side. Because so many sellers are still hinging their hopes on selling their overpriced house on the idea that rate cuts are going to save the day. But so far, the prospect of rate cuts is doing nothing to ignite buyer demand or the housing market. Now, what about the stock market, everyone? Because this is even bigger bubble than the housing market. Stock prices adjusted for GDP are at their highest level on record. You can see, going back to this chart, that the stock price to GDP ratio is 200%. Again, what this means is that stock market is valued at around 56 trillion compared to 28 trillion GDP. So the stock market's valued 2 times the size of our economy. The long-term average when the Fed cuts rates the last 15 years is a 72% stock to GDP ratio. So we are literally almost 3 times the long-term norm in stock valuations. And this is actually a data point that Warren Buffett came up with called the Buffett indicator. Warren Buffett, obviously the most successful long-term stock investor of all time, he came up with a data point to measure the over or undervaluation of the stock market. And once again, you could see it's calculated as the total US stock market value divided by GDP, 58 trillion divided by 28 trillion. So we get that 202%. And this model suggests that we're 63% above the historical trend line, that the stock market is strongly overvalued. And if you look here at the graph, we're over 2 standard deviations overvalued. We have literally never seen this type of stock market overvaluation before relative to the size of the economy. And so when you take all this data together, everyone, you realize that the only thing propping up our economy right now is a dueling asset bubble with a dueling debt bubble. We have sky high asset prices combined with sky high government debt. Those are the only things preventing thus far the collapse from happening. However, these things are not sustainable. We've actually never seen debt and asset values this high relative to the fundamentals. And so what that suggests is that if the unemployment rate continues to go up, which historically it always does once it reaches this point, there could be big problems. Because where homes and stocks are valued right now and how richly valued they are is assuming that we're going to have a lot of future growth. When home prices and stocks are so high, it's basically people buying them saying, we think that there's going to be a lot of growth in income and a lot of growth in the economy into the future. It's the only way to justify the current valuation. So if that growth deviates at all, if it slows at all, if it goes negative at all, problems arise. Now, Fed rate cuts haven't always led to a recession, however. This is important to understand. If we look at this graph and look at the gray bars in 1966, 1984, 1995, and 1998, these are the 4 times the Fed has cut rates historically where we didn't actually have a recession in the next 6 months. And I said to myself, was there something special about these times that we didn't have a recession that we should investigate? And are we seeing a similar situation today in some of the core numbers? Because this is important to understand, everyone. Let's do our due diligence. Is there any way that we could be wrong here on our assumptions? Well, going back to this table of the last 15 Fed rate cuts, the 4 out of 5 that didn't lead to recession had some very interesting characteristics. One was that the number of unemployed people was actually going down. So the labor market was getting better. There was fewer unemployed people year over year when the Fed cut in those 4 previous times in 1966, 1984, 1995, and 1998. In addition, GDP growth in those periods was a robust 4% a year. And so to me, this speaks to why we didn't have a recession in those 4 instances when the Fed cut rates, because the economy was very clearly getting better. Lower unemployment, robust GDP growth. In this case, it's the opposite. Unemployment is spiking while GDP growth is okay at 2.6%. It's certainly not robust. So that's even further evidence that the situation we're seeing today is unprecedented. I mean, you could try to say Fed cutting rates isn't a perfect indication that a recession is coming, but the only 4 times it wasn't, there was a reason. We had a strong economy. We don't have a strong economy right now. Objectively speaking, we don't have a strong economy. And so for you as a home buyer and investor out there, or someone just tracking the economy, understand that it is very likely the economy gets worse the next 6 months based off the historical record. And use that information to help educate your decision making. And I want to show you one more data point, everyone, that really hammers home the underlying weakness in the economy right now. And this is a private sector data point. This comes from a company that tracks the US job market. It's a private company. And I know people like the private company data because it doesn't come from the government. There's a lot of people that don't like some of the adjustments the government makes to their data. They just lowered the employment growth last year by 800,000, right? So the government data sometimes is questioned by a lot of people, but private sector data, a company like Indeed, who I'm about to show you their data, they don't have really any incentive to try to hide things or adjust things. So let's see what Indeed is saying about the US job market. So Indeed makes some great data available here on their hiring lab where they show the changes in job postings and wages over the last 4 years, everyone. I'm going to take myself off the screen here so you can see better. The job postings index on Indeed is down 11% year over year. And what you could see is the job postings index, the number of job postings is now down about 45% from the pandemic peak and is now almost back to what it was before the pandemic. So significantly fewer job openings and the situation is just continuing to get worse in terms of fewer employers advertising on Indeed. In addition, 3-month moving average wage growth has also plummeted by 1.6% year over year to only 3.2%. So this is cold hard data from one of the biggest job aggregators in America that the job market is really starting to slow. So you combine that with the big increase in unemployed from the BLS and you say to yourself, there's problems developing here, which is why Jerome Powell is now hustling to cut interest rates. Going forward, I'm going to be tracking this data for you guys each week and each month on this channel. We're going to be looking at that job postings index. We're going to be looking at the mortgage applications. We're going to be tracking all of these recessionary indicators so you can know when the shift in the economy happens. So make sure to hit that subscribe button if you want this content into your feed every single week. And also turn on your notifications so you get notified when the video videos come out. Until next time, this is Nick from ReVenture Consulting signing off.